Well, thanks for sticking around. My name's Tim De Silva. I'm a finance PhD student. I know it's the end of the day, so I hope you're all as excited about student loans as I was at the start of the market. I'm not quite as excited about them now, but yeah, I'll try to convince you they're exciting. So the starting point for this paper is the fact that many governments around the world provide subsidized financing for higher education, which often takes the form of student loans. So in the US, these student loans account for around $1.6 trillion and around 10% of household debt. Now, the traditional way that these loans have been structured is similar to what we would think of as a debt contract, where borrowers make repayments on these loans that are mostly independent of their income. So these are the default contracts that we've historically had in the US that are known as fixed repayment contracts, and that generally speaking are difficult to discharge in personal bankruptcy. Now, an alternative form of financing that goes all the way back to Milton Friedman would be an equity contract in which borrowers would repay some share of their future earnings. Now, in practice, there have been relatively limited successful examples of these types of equity contracts. But more recently, several governments around the world have introduced a contract that falls somewhere in between debt and equity, known as an income-contingent loan. So what is an income-contingent loan? Well, like in an equity contract, borrowers make payments that are a function of their income. But unlike an equity contract, these payments are capped by the amount that individuals borrow. So once we start thinking about the trade-offs between these different forms of financing, on the one hand, more debt-like contracts, on the other hand, more income-contingent or equity-like contracts, a very natural trade-off arises. So on the one hand, the problem with traditional debt-like contracts is that they force borrowers to bear most of the risk associated with the investment in higher education and fluctuations in their income. While income-contingent contracts can provide borrowers with some insurance against this risk by reducing repayments as their income declines. But of course, this insurance comes at a cost. In particular, these types of income-contingent contracts create an incentive for borrowers to lower their income in order to lower their repayments. An additional trade-off, in addition to this ex-post trade-off between insurance and incentives, is an ex-ante trade-off. So on the one hand, income-contingent contracts may encourage borrowers to take more risk. At the same time, they might incentivize over-borrowing. And a final difference between these income-contingent and debt-like contracts is that the set of borrowers who select into these types of contracts are likely to be fundamentally different. So for example, borrowers with lower expected income may be more likely to select an income-contingent contract, generating adverse selection. So in this paper, I study a setting that allows me to focus on this trade-off between using income-contingent repayment to provide borrowers with insurance, but also potentially disincentivizing labor supply, which I call throughout moral hazard. So in particular, this paper asks the following question. Conditional on borrowers' choices of degree and the college that they go to, how does income-contingent repayment affect labor supply and ultimately borrowers' welfare? So I answer this question empirically in the context of Australia's income-contingent student loan program, which is a useful setting for two reasons. So the first is, as I'll show you, it provides me with variation. So in particular, in Australia, repayment rates on these income-contingent loans exhibit discontinuities as a function of income. And then second, going back to the discussion we had on the last slide, in this setting, there's no room for adverse selection because there's only one government-provided contract that's income-contingent. Now, to study this setting, I implement a research design in which I examine bunching in the income distribution, both before and after a policy change to the income-contingent repayment schedule. And to implement that research design, I construct a novel data set by linking income tax returns for the universe of Australian individuals with administrative data on student loan balances. To answer the second part of this question about how income-contingent repayment affects borrower welfare, I build a lifecycle model that has two key ingredients. So the first is endogenous labor supply, which creates scope for the moral hazard potentially created by income-contingent repayment. And the second is incomplete markets, in the sense that individuals face some uninsurable income risk that income-contingent repayment can provide them with insurance against, or reducing payments when their income falls. I then use the model in the paper in two ways. First, positively, to translate what we see in the data into estimates of preference parameters, and then normatively to characterize the optimal amount and form of income-contingent repayment from the perspective of a social planner that's thinking about implementing a single income-contingent contract. Now, before I go any further, I want to be clear about what this paper is and is not about. So this is a paper in which I'm studying the design of student loan contracts, taking ex-ante education choices as given. And so as a result, I think of this analysis as being informative of how we might think about restructuring existing debt contracts among existing debt holders. So for example, the $1.6 trillion of outstanding student loan debt that we have in the US. The first part of the paper uses the Australian study to identify how labor supply responds to income contingent repayment. The key source of variation that I use is shown here on this graph. So in Australia, all student loans are income contingent. The way this works is on the x-axis, you have your individual income, and on the y-axis, you have the fraction of your income that you repay. So this is, and the blue line is what this repayment schedule looked like prior to 2004. And to 2005, the government changed the repayment schedule from the blue line to the red line, and in particular, increased the threshold at which borrowers have to start making student loan repayments. So I use this schedule in a variety of ways in the paper. Here I'm going to show you how the change in this part of the threshold right here kind of affects borrowers and how I can use that to study how their labor supply responds. So what I'm showing you here now is a graph of the income distribution among student debt holders in 2002. X-axis is income, y-axis is the fraction of borrowers. And so what you see is that relative to this vertical line, which is the point at which borrowers have to start making payments on their income contingent loans, you see bunching in the income distribution. And that bunching is there in 2003 as well as in 2004. Now in 2005, remember the government changed the repayment schedule on the income contingent loans, and you then see two notable changes in what the income distribution of student debt holders looks like. So first, all the bunching at the old repayment threshold disappears completely. And then second, it reappears right below the new repayment threshold. And that bunching remains in 2006 as well as in 2007. Now, what I've shown you here is evidence that borrowers adjust their income in order to lower the repayments. The natural question is, what is the margin of adjustment to which this is happening? Is this like tax evasion? Is it adjustment of hours worked, for example? So in the paper, I won't have time to show you today, but I actually collect data on hours worked. And what you find is that borrowers who locate below this repayment threshold tend to work around 1 to 2 fewer weeks per year than those who locate right above it. So given I have that empirical evidence, and there's much more in the paper that I'm going to have to skip, I then use this evidence to discipline a model of labor supply that I can use to think about optimal contract design. So the model that I write is a model that's it's a life cycle model where individuals have debt, markets are incomplete, which creates scope for income contingent repayment to provide borrowers with insurance, and then labor supply is endogenous. The model is relatively straightforward. Individuals are born at age 22 with heterogeneity in their initial assets, ability, as well as the amount of debt that they have. And then they go through their working life, making choices of how much to consume as well as how much to work. Once they hit age 64, they then solve a standard consumption savings problem in retirement. Now, there's a government in this model, so I'm going to be thinking about solving, from the perspective of a government, the problem of how do you maximize borrowers' lifetime utility, given a fiscal cost that you want to spend on student loans. And so the government's going to collect revenues from progressive income taxes and debt repayments. And then on the expenses side, it's going to have the initial debt that it lends out to individuals, as well as a realistic social insurance system. So for example, unemployment benefits and a retirement pension. So the key challenge in matching this model to the data can be illustrated by looking at this graph. So what I'm showing you here is the bunching before and after the policy change. And what you see is that there's this bunching below the repayment threshold, and this is consistent with the fact that some borrowers are responding to the fact that by locating above the threshold, they're going to have to repay more. But when you look at this graph a little bit harder, actually what's quite puzzling is the fact that there's so many borrowers who choose to locate right above the repayment threshold. And in particular, if you're somebody who chooses to locate right here, you could have more money, in particular $1,400 more by moving to the left of the threshold, and you have to work less. So in our standard models of consumption savings and labor supply choice, nobody would ever want to locate on the right side of the threshold. So the key difficulty in the paper is kind of how do we reconcile what's in this evidence to what's in the model. Now I'm going to skip, oh, this shouldn't be here. Sorry, ignore all the equations. So I'm going to skip the details of the model, and basically what I then do is use that bunching variation that I have in the data to estimate what parameters of individuals' choice of labor supply, as well as what frictions do they face in adjusting their labor supply, can reconcile that evidence. So what I'm showing you here on the left and on the right is bunching below and after the policy, before and after the policy change in the data. And the model that I end up developing when I estimate it using the simulated method of moments can replicate this relatively well. So the key thing that I do with this model, which is the reason I went through the whole exercise of using this variation in the data to structurally estimate a model, is use it to think about what are the effects of different contracts in this model. So the first thing I do is compute what is the welfare gain from moving from a fixed repayment or debt-like contract that we've traditionally had in the US to an optimally designed income contingent loan. The number on the left is telling you that moving from that debt contract to the income contingent loan in the model increases borrowers' utility by around 1.3% of lifetime consumption. The graph on the right is showing you what that contract looks like. I then consider a few other contracts. So in particular, what happens, for example, if you use a fixed repayment contract where I let you stop repaying if you're unemployed. What you see is that contract doesn't do as well as an income contingent loan, and that's because it doesn't collect payments quickly enough from higher income borrowers. And by collecting payments more quickly from higher income borrowers, an income contingent loan can then provide even more insurance to lower income borrowers at a given cost. Now, another contract you might think about is an income contingent loan where I forgive your debt after a fixed horizon. So this is something that we've had in the US. It turns out that in this model, that actually does quite a bit worse than that optimally designed income contingent loan. And this is because once there's a horizon at which borrowers know they're going to repay their debt, they're a lot more willing to reduce their labor supply in order to locate below this repayment threshold. The final contract that I consider, and then I'll conclude, is an equity contract in which borrowers make income contingent repayments, but they do this forever, not until they just repay off their initial debt. And so what you see is that this actually generates a larger welfare gain, and that's because in this model, you're able to redistribute more from high income to lower income borrowers. But once you step outside of the baseline version of this model that I write down and allow for borrowers to select across different contracts, what you actually find is that the problem with this equity contract is that the welfare gains from it are so dispersed. And so what that means is that higher income borrowers are going to be likely to select out of this contract, generating adverse selection and unraveling all of the welfare gains that come from it. So my last minute, let me conclude. So I want to conclude by placing this paper in the context of the bigger picture debate we've had on student loans in the US. So in the US, we have what many people have called a student debt crisis, where 25% of borrowers default within 5 years after graduating. And one possible solution to this crisis is to use an income contingent repayment contract, which is something the Biden administration has tried to do with its new SAVE loans. So in the context of this debate, this paper provides both evidence and a model to calibrate the effects of the different types of income contingent contracts we might consider, and it makes 2 points. The first is that the labor supply distortions that these contracts create are there, but they're not large enough to justify avoiding these contracts entirely. And the second is that among the income contingent contracts you could consider, income contingent loans in particular are relatively effective and robust. So the key open question in everything I've shown you and that I'm hoping to pursue in the future is how these different types of contracts affect ex-ante choices. So for example, choice of major. And then more broadly, this paper is part of an agenda I have in which I'm interested in the effects of state contingent financing in other settings. So for example, several firms are now taking out revenue-based loans, which is kind of the corporate finance equivalent of the household contract I've shown you today. Thank you, and I'll welcome any questions at this time.